I'm going to enter a bear call on AMD, and I'm going to say that a while ago I sold, for the June 9th expiration, I'm sorry, let's say that I sold the one gapped above it. So let's cheat. Let's do the 125, 130. And we're going to use similar prices that fellow investor had mentioned, in the sense of I'm going to sell this for, let's say, $1.45. And this might have been when AMD was down at 102, 100 or something along those lines. And there's a 5-point spread. So we're going to get this for, let's say, 80 cents. Whoops, got to have my decimal point there and there. Don? Perfect. Yeah, this is right in the wheelhouse of what I'd look for in a bull put, credit spread, or a bear call. At the time, it was probably an 80, 85% probability. No earnings between now and expiration. But it got buoyed up by NVIDIA, just as we saw for fellow investor, who does say thank you so much for the insight. You're welcome, fellow investor. That's why we're here. All right, so here's a position, a fake position. You won't find these prices. These prices maybe didn't even exist when AMD was down in the 100 level. But as I mentioned in those videos, Don, check them out in the playlist, the one on the management techniques, the ones on the stops on credit spreads, or the stops on debit spreads. Again, you said, would you ever consider putting a contingent order for a long stock in just below the short call strike price? I personally don't use contingent orders or hard stops, Don. I think you've heard me mention this before. The reason why is if I'm tracking a bull put credit spread in my power options portfolio, a bear call spread, I've set the alerts in my portfolio, and I have the advantage to be here at screen all day. I've missed opportunities to close and roll a position for limited loss or make an adjustment when an alert went off because I was on a coaching session or I was hosting a webinar. I don't stop the coaching session if one of my alerts is triggered. I don't stop a phone call if one of my alerts is triggered. I don't stop a webinar if one of my alerts is triggered, okay? But the reason I decided when I was testing this strategy, the preferred 2-week out structure I use for bull puts and sometimes bear calls, Don, is the alerts that I set. As you mentioned, I found there's a couple alerts, triggers I like to use. In the search tool for a bull put spread, but it'd be the same for a bear call. So let me change my mind here and talk about a bear call in the head. So that's what we're looking at. So here's our bear call spread, and the stock is between the strike prices. I did this for a reason. The triggers I might use, but not a contingent order, because I want the ability to be able to go in and close the position and fight for midpoints if I'm closing it. I don't want it to be automatic and get the bid price to sell to close the long and pay the ask price to buy to close the short, because the movement of the stock that caused that to trigger might have increased implied volatility, and I might be getting, turned over the barrel, for lack of a better term, by getting filled at market prices with a contingent order set with my broker. If your broker allows you to set contingent orders and allows you to set the close at midpoint, that might be okay. Mine doesn't. It's automatic worst case scenario. So I set the alerts on power options and I get notified. When I open a bear call credit spread, the criteria that I'd be using for the underlying is the stock would be below the SMA 20. It'd be in a bearish trend. Also, I'd be looking for one of those negative MACD crossovers recently where the MACD was declining. And I also probably had a delta or a probability. My probability was probably 85% on the short option that the stock would be below that short call strike price, maybe a delta of 0.15 or 0.2, or delta of 0.5 to 0.2, 0.15 to 0.2, okay? There we go. These are all alerts I can set in Power Options. I'm going to set an alert to notify me if the stock moves above the SMA 20. MACD isn't in there yet, but it will be hopefully soon. But if I see a positive MACD crossover on a bear call credit spread, that's a secondary trigger. If I get 3 at once, and then of course my delta moves up to say 0.4 or 0.35, then I know it's going against the direction I wanted for the spread. The main ones I set are the stock, the sentiment of the stock, the SMA changing direction, seeing a MACD crossover, and if the stock is within 1% of my short strike price. Okay, so to answer your question, even though I went through all of this, yes, I use a stop on the underlying security. That's my main one. If the stock reaches within 1% of the short call strike, I'm here at 125. So if it reached 123.75 at that time when I was in this spread, I would have started to seriously consider which one of those 8 adjustments am I going to use. Again, you could put in a contingent order to just close the spread, but you might still be looking at a 40-50% loss. And if my spread, the sudden movement causes my spread to hit 50% of the maximum loss, here at 435. So we'd be at about $2.17. If my monetary loss, if I close the spread, is 217, 218, 220, I'm just going to take the 50% loss and move on. Not even, whoa, sorry, folks. Not even going to try to manage it in that case. So I use the stop on the stock, 1% of the short strike price. That's my preferred. It's not maybe even the best. You could just set it, if it's just 1 point below, if it's 2 points below. If I'm doing a weekly trade or a daily trade, might talk about that a little bit in a moment too, Don. If I do a daily trade, that stop has to be adjusted a little bit differently. It's more like 0.5% because the stock's going to fluctuate, and I don't want to close the spread too early because I'm fighting for nickels and dimes in a 0-day to bear calls for credit spread, 0-day iron condor. Not something I do, but something I'm testing, as we talked about last week. Okay, so yes, Don, I would do that. But again, I don't use straight contingent orders, Don, with my broker because I want to fight for the midpoint. Okay? All right. Now, I also wanted to show this for fellow investor because I don't know if these were the right prices, but I can tell you this is near the average of what I get for an out-of-the-money 2-week out bull put, bull call debit spread. The average returns around 14.8%. Average win rate in the right market conditions is around 83 to 87%. Success rate on the positions, and of course the average loss is kept to about 48.9 following those rules. So this is a realistic number for this position before the big jump happened with NVIDIA's earnings when AMD might have been fluttering around that 101, 105 range. Now what do we see? The stocks are between the strike prices. So I just wanted to show this as an example. Could the pendulum adjustment work in this case? What do I have to do? I'm going to sell to close the 130 and buy to open the 120. I'm going to keep the 5-point spread ratio between the two. And with one move, I'm going to try to convert our bear call credit spread, where the stock has moved between the strike prices, into the bull call debit spread using the pendulum adjustment. I'm going to clear this out first, clear those drawings out. This is our June 9th series, correct? There we go. So we're going to sell the 130 at 360, buy the 120 probably at about 910. Okay, 907 midpoint. And there you go. That's the pendulum adjustment in action, fellow investor. When the stock was between the strikes, we had the 130. We did have the potential, remember, for a 14.9% return. This lowers it down to only a 1.8% return, but in one swing, I turn a potential that could be a 50 to 60% loss on the position or higher if it kept going, that if I think AMD might continue to move up in the next 14 days or so and stay above the 125 level now, my initial sold point, the pivot point, I can still make a 1.8% return on the position. Right? So that's just a look at how the pendulum can work, but it usually requires the stock to be between the strike prices of where you initially started. Once it moves above that, and these two options, the one you originally had and the one you're rolling to, are too far in the money, you don't get that time value swap in those positions. All right, so following up on that, the criteria, fellow investor, real quick, is there a way to screen for earnings in the software? Absolutely, every strategy. So I mentioned bear call credit spread. Let's go to search. It should pull up that default I mentioned, weekly bear calls. What did I mention about return? Yeah, okay, so these are a little bit lower, but a 16, a 10, and a 9. So that's 35. So it's about 11.3% average return. It's been higher recently, but just some basic criteria. What can you look for? Minimum net credit, minimum return, range out of the money, probability, limiting the bid-ask spread, maybe looking for some volume in open interest. You can screen by implied volatilities, implied volatility ratios as well. Strike difference if you preferred $1, $2, $5. Stock technicals, as I mentioned. Negative MACD crossovers, what I'm looking for in stock under the SMA 20. You can adjust that as you want. Most importantly, for every credit or debit spread, default search. You go to the fundamentals, I'll put a strike price limitation, earnings per share growth from doing a bullish spread, but always earnings, not between now and expiration. You always want to double check and do your due diligence, but you can specifically screen for earnings dates between now and expiration, not between now and expiration. Some strategies such as straddles or strangles will have the opportunity to select to see earnings between now and X weeks from now, or now and X days from now. Buying a straddle, buying a strangle for an earnings play, fellow investor. So you'll be able to see that as well in those strategies. But absolutely, always want to do the due diligence, but the defaults will most likely have that. Let's just take a look at initial values, the default search to help you get started. A lot more spreads there, lower probability range. Not between now and expiration is checked. Okay, so that's something we always look for in those cases.